So Rachel Reeves announced in the budget that she didn't think it was fair that investment income essentially was taxed at the same rate as earned income. So she has decided in her wisdom that property income, interest income and dividend income will be taxed at higher rates than before. So the changes to dividends are being brought in from 6th of April 2026. The dividend allowance of £500 hasn't been removed yet. There was rumours that it would have been. That's been kept in. So the first £500 of dividends will be taxed at 0%. Beyond that, depending on what tax band you fall into, the rates for basic rate taxpayers will increase from 8.75 to 10.75. High rate limit increases from 33.75 to 35.75. But strangely, the additional rate limit of 39.35 remains unchanged. So there will be maybe not necessarily noticeable, but there'll be a definite increase on your investment income for your traditional SMEs because you've got the mix of salary and dividends. I suppose what it may force you to revisit is, have you got the right balance between salary and dividends? It may be that you did have the right balance 3 years ago and it's not been reviewed, and it's just a reminder to plan for next year, essentially. That may be influenced also by the payroll stuff we mentioned earlier with employers and I. It may have been that maybe you didn't use the allowances before, your workforce has grown, and again, it needs to be reassessed. But yeah, there's definitely going to be an increase for SMEs on the dividend front. For property and interest, so bank interest or interest of any sort, we've got an extra 12 months. So that won't be brought in until the 6th of April 27. Property income at the moment can have a separate allowance of £1,000. Interest income can have a savings allowance of £1,000, 500 or nil, depending on what tax band you fall into. So basic rate taxpayer would get 1,000, higher rate would get 500, and additional rate taxpayer would get nil. The rates of tax in the bands that the interest falls into, or property, will go an extra 2% on all bands. So 20 would go to 22, 40 would go to 42, 45 to 47. So I suppose the point to consider there, probably more with property, is if you've got a large portfolio, is it worth incorporating? There may be significant costs, there may not be, there may be reliefs available, but it's probably another kick to review the efficiency of the structure. It might sort of twin with inheritance tax, whereby it might accelerate your position on gifting properties to reduce your income tax provision and reduce your inheritance tax provision. But again, it's probably not significant enough to influence the decision on its own, but probably part of the wider issue. It's another talking point essentially.
No, I think that all makes sense. Like I say, we spend a lot of time working with our clients on the salary versus dividend planning. I think still around up to the £100,000 mark, you are, and there's a lot to factor in now. Yeah. But how we do a calculation is we will say, okay, what is the cost of the company of paying someone a salary and a dividend? So yeah, it would cost £12,500 to pay the salary, but you get 25% corporation tax saving, and obviously that could be anywhere between 19 and 25%. But so again, that's something else to factor in. But generally speaking, if you can afford to pay a £6,000 dividend, chances are you're making good profits, and you're paying the tax at a higher rate. So yeah, how we tend to look at it is we say, okay, well, the £12,500 actually only costs that, so less than 25% that you save, but then the dividend costs what the dividend costs, because that comes in after tax, and then we would do a comparative to say, okay, what is the equivalent if you put all of that through a salary? So I think, like I say, the equivalent of a 12.5 grand salary plus say 47k in dividends is around a 67k salary, and then so we would say, okay, what is the take home on that combination versus what's the take home on paying yourself 67k salary? Yeah. We know it costs a company the same, because when you factor in all the taxes, national insurance, and so that's why we're unable to advise our clients. And again, it's case by case because of things like employment allowance. It comes, you've got to potentially consider, and the sort of the variable rate of corporation tax. But like I said, we would be fairly comfortable we do remuneration planning work with our clients, so we can advise them on that. And then, like you say, the property and interest, it does feel like if you were to today to say, look, I'm going to build a property portfolio over the next X years, but like 5-10 properties, would you be immediately? I know there's other things to factor in, but would you be going down? What would you do?
So best case scenario, I would be planning out exactly what I wanted to do over that period.
Yeah.
Because if you know you're going to aim for sort of 5, 10, 15 properties, whatever you're looking for, we could essentially model what that would look like, depending on what you want to extract. Because you could be looking to do that and you have salary or pensions, and that is essentially an investment business. Or it could be that you're doing that because you need to live off the money. And obviously the tax advice on either option would be completely different. The risk that we have is sometimes people buy one property and then buy another and eventually get to 20, but they didn't plan to it.
Stumble into a property portfolio.
And then they find out it's in the worst structure, and to move it is really costly. So it's not necessarily always possible, but the sooner you can kind of get advice on that long-term plan, you can often save a lot of money. And I mean, there's no perfect scenario, but we've had quite a few where it's been actually, let's put it in a company, or sometimes they've wanted to put it in a company and it's actually better to be in personal names. Depends on your age, the income, and so many other factors. The general rule of thumb that people read online is it's better for a company. And it can be, but do you know what I mean? It's not always. And we've had quite a few recently where it would have cost them probably £250,000 more, plus annual taxes as well, to put it in the company. So it's basically, don't just proceed without doing that, because the transactional fees to change it later are so significant. And I suppose one other point, back to what you just mentioned, Sam, about salary versus dividends, is regardless of which one's better as well, is there's also a factor to consider of the timing of your tax. So if you're on dividends, the tax on the screen is obviously paid through self-assessment, whereas salary, assuming your tax code's right, your salary is paid as you go. So it might be that dividends may be £500 better per annum, but you'd rather know that your personal cash flow is managed. So sometimes you may opt for the salary option just for clarity. And you've also got the consideration of you've not got to monitor reserves as well, because a salary can be paid regardless of reserves, but dividends can only be paid up to that level. So there's many factors to consider, and we can do the tax angle, obviously, but we can also look into the other angles that might drive your decision as well.
Yeah, we've worked with people who have become overnight successes, and they've just been advised salary dividend is the best way forward, but then they just dread January and July. Like I say, the company has all the money, it's got excess funds, but they've took out so much that they now are of the understanding that, okay, even if they have got this large tax bill to pay, they're going to have to take it out of the business, which is going to add to the tax bill the following year. So, like it can be, the cash flow is one thing to consider, but like I say, just peace of mind is very important to some people as well. So not having to think, oh, I've got to put some money aside for January and July. So yeah, it's
there's many factors to consider.